So I will briefly introduce our speakers. For tonight, we have quite an intensive, intellectually intensive topic today. This is private equity, one of the most sophisticated part of the investment industry. As you know, it doesn't enjoy the simplicity in analysis of earlier stages financing, like the seed or venture capital financing. And on the other hand, it doesn't enjoy a lot of attention and a lot of work of the analytical community of rating agencies as publicly traded companies enjoy. So private equity is more of an art sometimes. You have to structure very complex transactions, do quite a lot of research in private equity. But on the other hand, private equity is the area where a lot of fortunes are made, and a lot of interesting transactions happen every month and every day. So after this brief introduction, I will give the floor to my colleagues. The two of the speakers are here today. We have representatives of three private equity teams here today. One is Da Vinci Capital. It's one of the leading local private equity funds, which was established in 2007, and it's one of the most active mid-market private equity funds. So I will give the floor. The first speaker probably today will be Olek Teonidis, who is executive director of the fund since its inception, since the beginning, and he will give you the first introduction into private equity. The other team, the speaker is not here yet. The team of Gazprom Bank, merchant banking and private equity team. The head of this team, Vladimir Yarmish, we are expecting him in about... he's here. So he, in fact, all three speakers are here. Vladimir Yarmish will be the other speaker. And the other team is Vermouth Asset Management. Probably among the three companies, it's the longest present independent family office private banking institution. It has German origins, and it operates in Russia since 1999. So today we have the head of risk of the company, Marina Shestakova, who will be the third speaker. I don't know what will be the sequence. I hope the speakers will spread the turns in a friendly manner. So at this moment, I will give the floor to the first speaker, whoever he will be, or she.
Let me also say a quick word as far as the CFA. Just switch on your brains and listen to some very interesting topics from our speakers. And I'm really glad to see here managing director in Da Vinci Capital in the fund in which I'm working for more than 1 year. I'm really happy to introduce him to you. He's very bright and intelligent private equity manager. So, Olek, thank you for coming.
Thank you, Denis. Actually, good to find something new about yourself. So the presentation is in Russian. I mean, the voting was done, but I think on Q&A, feel free ask questions in Russian. I think it will be simply and basically I can answer in Russian, in English, etc. So, what is private equity? I mean, from where the private equity appeared, The industry is quite old, meaning that it's already a 70 years old industry, and its organizational structure, it took from the British Empire when the investors, merchants, would hire a ship, would hire a captain, and the captain would be a GP, the person who has unlimited liability, who took over the ship in order to ship the goods into some other areas. And this is where it's all started, the distinction between LP, limited partner, and GP, general partner. So it's actually coming from like more than 200 years old English trading practice. But initially the industry till the 80s it was quite small, meaning that there were a lot of restrictions where insurance companies, pension funds could invest, and after the release of the restriction, when basically banking sector was open, insurance companies started, as well as pension funds, to invest. This is where it's all started. This is when big money started to flow into the industry, because the government in US lifted the requirements on the risks the pension funds, banks, and the insurance companies could take. When it became really big is in the 90s. This is where the industry were mainly investing in the growth stories, basically meaning the companies that grow a lot. After 2000, when the industry became so big and the funds operating $5 billion, $10 billion appeared, this was the time when the industry switched from the growth type of investments to more buyouts, when the private equities would buy public or private company and then would make a turnaround and would list it again or would sell it to some strategic. And this is, if you go to Europe or to US, this is the main focus of private equity. They don't invest like, for example, investment style more familiar for emerging markets. For them, the buyout situation are more familiar, meaning they buy usually controlling over 100% and they make big bets. And this is what presented here. Where I would see more a stage of development where the industry was more in the 90s. I mean, most of the private equities, they don't go for control. They invest still more looking at the growth stories. But soon the situation, I think, will change. So from where the money flows to the industry? As I said, the insurance companies, they have around 7% of the capital they can freely invest into risky investments. And this is where the private equities would qualify. As insurance companies in the world, their reserves usually something around 20 to 50% of GDP. We're talking about big portion of money. But also the pension fund is actually, I would see, the main source of the funds for the industry. But as time evolved, currently we have government state-owned funds that appeared quite recently. I think they started to appear only like 10, 15 years ago. And currently, as you heard, in Asia, in the Middle East, they are quite big funds. And we started to have also some appearance that something similar may happen in Russia. Also banks. Banks invest, similar to insurance companies, some portion of risky capital to the private equity. Then the big portion of money comes from the family offices. And usually the way it works, the family office would provide the money to the fund of fund. The fund of fund would provide the money to the private equity. And the starter ticket would be something like investment from $10 or $20 million for the large funds of funds. For the smaller one, they take the minimum side of the investment is lower. And of course, you have high worth individuals. They invest directly, they invest through the private equities, through funds of funds. So there are different ways. And then basically the private equity would take this money and would invest into companies, into stories. The way the private equity is structured, the investors would invest in limited partnership, meaning that they have limited liabilities in terms of what their responsibilities over investments, because the so-called general partner, the partner that has unlimited liability, is actually GP, is a team of private equity. It's a team of private equity that would sign with the LP fund, LP agreement, limited partnership agreement, that would give the rights to basically make investment decisions. Limited partners may affect these decisions or may not. Usually they have very limited influence only through so-called advisory boards or similar structures where only not typical transactions would have to be approved. So private equity is actually managed by GP, like a captain that took over the vessel in order to ship it to ship the goods to another country. This is from this English structure this appeared. So it's quite old if you think about it. In terms of how the funds flow, in the first stage, how the private equity are organized. Usually it's 1, 2, 3, 4, 5 people would basically meet, decide, okay, we're creating private equity. Usually from anchor investors, they would require to put some of their money, initial seed money, into the fund, and they would develop the strategy of the fund, and then they would search for the money. And usually to raise big money, you need so-called anchor investors. Investors that would put, I don't know, for some funds this is 100 million, for some funds it's 30 million, but some reputable investors, usually it's big funds of funds or EBRD or IFC or DAG in the past. Currently they don't invest. In the past they invest heavily, but I'm talking about current moment. So typically it's funds of funds, and there are plenty of them. Typical size 10, 5, 30 billion asset under management funds. And there are two periods, so-called first closing and the second closing. So typically in the first closing, the fund would collect 50% of its money from its LP investors. And then basically we call it first closing, meaning that with this 50%, the fund already can invest something into some stories. And this is the time when the fund starts to invest into some companies and usually have 1 year to make the second closing or the final closing. This is when, after the final closing, the fund, the GP cannot raise funds anymore for some time. Usually it's 2 to 3 years. And this where you can see the funds first flow, and usually after the third or the fourth year, you starting to have the first exits, and this is when you start to have positive cash flow coming. And the idea of private equity all over the world is the same as far as I know. The target profitability, we call it 3 times, or 3 times cash on cash. This is the main parameter for us. We're looking at IRR, but IRR is not that important as cash on cash. And our promise that we give to investors, and this is the same promise give other private equities all over the world, is to make 3 times. On invested dollar, we need to make 3. This is our promise. And if you typically call it in IRRs, if you make it 5 years, this is 30% IRR. This is why quite often you see that private equity desired return is 30% IRR. How we select companies, I mean, where to invest. We're starting with, first of all, the industries, because especially in emerging markets, as I said, the style of investment in emerging markets is more growth, because local markets, they're still fast growing, and there are many fast growing companies. In more developed markets, you would have industries that are not yet saturated, the industries where some companies that were in the past developing very good, but because of bad management, usually it's the main reason, started to look cheap, and then the private equity would come and would make a buyout, turnaround situation, and then resell it after 2, 3, 4 years. So in our approach, we're trying to identify industries that are promising with respect to growth. And this is like the first criteria. Then we're looking at, within these industries, how the companies are differ. Who is the leader, who is the most fast growing, who is the most promising company in terms of products, services, you call it. And then we're looking, I mean, do we have a chance to make a deal? If there is a deal or not? Because, I mean, you can find very good, attractive industry, spend a lot of time, but no deal, I mean, no money earned. This is something which is, we're not interested. And at the time of making an investment, 40% of the time that I, for example, present to investment committee, I spend how we would exit. Because it's easy when you have the money to make a deal, but then, okay, to whom you will sell it, your investment, because this is for you the important aspects of monetization. And making the exit, particularly in Russia, when there was a period, for example, if you take 2007, there were 14 IPOs. Currently, I mean, in Russia in the last years, there were just a few. Western strategics that used to buy many companies before 2008, even after, currently they're also not showing up. So it's a quite important question to be answered. I mean, what is our exit strategy? What would we been doing to exit? Then, of course, when we're looking at the company, most important, at least for me, I'm looking a lot on the team. I mean, who is driving the business? Is it the management team? Is it the owner who is not heavily involved anymore in the management, and he has more management that executes his orders, but he doesn't spend enough time? Or it's the company works more like typical Western-style corporate structure, when you have, quite active management team, diverse, when the CEO has a successor already in place, etc. So team is important, and generally how the business is managed. We are not venture capitalist firms. We don't invest into companies that are 1 year old or that are small in scale. We're looking at developed business, and usually developed business is supported by the financial results. So we're looking at the companies that generate revenues, generate profits, and have a business model that's proven to be sustainable, at least in the past, and has certain promises in the future. Of course, the strategy going forward, because when you invest into a company, you're not getting the earnings the company showed in the past. You're more looking at the future projection of the company. So for us, the strategy and how it's realistic and how it will be converted to actual cash in terms of dividends, profits, EBITDA is quite important. In terms of the actual deal, typical deal has quite standard stages. Either our team, for example, I don't know, I can give you example from mine. Like in 2012, I was looking at the consumer boom. Everything was booming. I mean, consumer banks, Russian consumer banks started to appear in the list of the most profitable banks globally. And the consumer boom in 2011, 2012 was crazy, meaning that this post-credit cards businesses we were growing 100% a year and no stop. And but usually it happens that then you have a period of decline. Then you have a period when the banks have to clean the balance sheets. And I had a simple idea, what about collectors agencies? I mean, they would be the one that would take over the problem of the banks, of this consumer boom, and would be the one that would benefit. Then I looked, I mean, who are the players in the West, what kind of models exist, and what's going on in Russia. And after basically picking up two targets, operating in two different models, in the end, it's completed with a transaction. When we invested quite lots of money into this business, and hopefully the assumptions were correct. There was signs the central bank would lift reserve requirements for the consumer finance banks, and it did. It did actually, for some defaulted debt, it lifted more than 2 times. So the banks realized tremendous pressure on its capital, on its reserves, that would force them to sell defaulted debt more freely as they did in the past. And 2013, 2014, 2015 is the market where defaulted debt grows 100%. This is official statistic. I mean, last year, defaulted consumer loans they were only 400 billions. Now, according to the central bank, the number is 800. So the market where we picked up already grew by 100%, and this is what we're trying to identify. And in terms of transactions, they're quite usual. You would find the target, you would check who are the shareholders, you would speak with the management, then basically you would make attempt, okay, you can make cash-in transaction, cash-out transaction, and as soon as some of this assumption hooks up, you pass usually through 3 stages. When initially you approve the deal at preliminary investment committee, your investment idea is approved. Then you do business due diligence, reconfirming your assumptions initial, and then you do financial, legal, tax. What we do also, we do operational due diligence, meaning we would pick up some consultant, someone from Europe or from US, some consultancy firm or physical person with a track record, and would come and would ask the person to come and basically check the business model of the company. So we call it operational due diligence. Of course, we do integrity check, because our investors into our fund, as well as our other private equities, they are quite reputable financial investors. So we are very picky to whom we invest. So this we do as well. We call it QIC, but in the past I've seen examples when the deals in the final stage were basically cancelled simply because somebody forgot to do the QIC on the management or the owner. This is actually, I think this is the strategy of our fund too, for which I'm responsible. Usually you would see very similar in most private equities. It shows geography where we invest. Our fund can invest mainly in the CIS. But what it means, can we invest in the company that has revenues outside of CIS, but has a head office or large portion, I don't know, programmers? We were investors in EPAM. EPAM is a company that is based in US, headquartered in US, but most of these programmers are in Ukraine, Belarus, and some Russia. Yes, we can invest in such stories. For our statement that we promise to investors, the company must have a region or big exposure to Russia, but in terms of revenues, It could be that we invest in the company that only has 40–50% of our revenues in Russia. In the current environment, it helps a lot, because if you invest now in the company that has dollar or euro-dominated revenues, 60%, I mean, all this depreciation of the ruble would not be a big concern for you. Again, we would typically raise, I mean, in our example, and the private equities that we cooperate, I mean, 90% of our money are raised in Europe, in US, and of course we report in dollars. And every time we would have the shocks in depreciation, it affects our portfolio companies. And currently, for example, in our portfolio, there is a company that would grow 20%, but because of depreciation of the ruble, I mean, the company would show by end of the year almost zero growth in dollar terms. So all of this is important. As I said, we're looking at the markets, at the stage of the company. Is a growth stage? Is it already a big company? And it needs to consolidate the companies that are around and start to use more either market force or economy of the scale. Typically, when I said about we don't invest in startups or small companies, there is a reason for that. I mean, if you have a 100 million fund, you probably would invest only in 6, 7, 8 deals. So your minimum investment size would be between $12 to $20 million. So immediately all startups would not qualify for that. Also, what we do, and actually I would see that we are one of the pioneers in this. Sometimes you can invest in a big company, even though your own investment would be only 10, 15, 20 million dollars, the total deal size that you drive would be 50. And this is exactly what we do. The reason, the way we do it, we would find the co-investors, either that we would invite to come to under our umbrella, meaning they would invest for so-called co-investment vehicle that we would create for them, that would be managed very similar to the fund through LPA agreement. Or this is more, we do it when we would need a very technical operational partner with, for example, with huge IT expertise. We would ask them, okay, come over, we found this deal, please come, we make this deal together, but your voting rights, because you don't have a presence in Russia, for example, and supervision of the company, you give it to you. This enabled you to buy a stake in the company bigger, so you have more, let's say, voting abilities, rights, etc. Also, you can benefit from this if you receive some additional profits, like carry, that we have some arrangements through our co-investors. And generally, it allows us to also to bring the expertise into a deal. So when we pick up for example, one particular target, I'm immediately looking at what are GPs in the West that had success stories in these businesses. And usually we would call them, we would invite them to the deal, or would ask the advice to find operational partner after the deal. And this person could come at the due diligence or after be our representative at the board or be independent. And this is all done in order to recheck that our investment choice is correct. So we spend a lot of time on that. This is my last slide. This is more in terms of how we sell, because private equity industry in Russia is extremely small. The number of funds that are currently investing, that raise funds, there are only 6 of them. 6 funds for entire Russia. I mean, you have other private equities, but they already invested their capital and they more looking for exits. But the funds that are investing, it's only 6. And from this environment, it's good, I think, that we are cooperating. In many deals, we would sit in one company. For example, we do the deals with Barings, we do the deals, in the past we did the deal with Russia partners. We are sitting in a portfolio company with Elbrus, etc. And besides those that I told you, there are just a few others like Kaplan and UUG and at Da Vinci, and that's it. That's the private equity industry that is actively investing. I mean, you have other private equity players, but they are so-called in the dry out stage, meaning that they exiting from the investments they're making. And in the current environment, sanctions, etc., fundraising for Russia is something that is not going to happen in Europe or in US. We have, of course, our own association. We're more pushing the government to create what the government created in Kazakhstan, what you have in many other countries, state-owned funds of funds that would invest into private equities. And for us, it's very important to receive first anchor big investors, because this is what glues other types of investors to your fund. So this is what we are pushing and aiming currently. In terms of, this is, by the way, this is April 2013, so these discounts that are presented here, you can multiply by 2. And this shows how cheap Russia is in respect to the capital markets. So, of course, by looking at these companies, by looking at these multiples, you would think Russia is a fantastic place to invest. But the reality is, the deals that would qualify for us, they would be only a few. We don't do the deals that are linked to some kind of, even if it's 10 or 15% businesses linked to corruption, we don't do it. We don't do the deals where the influence of the state is quite big. And this is 50% of the economy, so is off. We invest mainly in the companies that are transparent. And trust me, there are not so many transparent companies in Russia. We help the companies to make them transparent, but there is a minimum requirement that the company needs to qualify. So all of this makes the industry actually quite fun. You know, in terms of our daily work, once a week we would look at the new cases. Once a week we would look at how our portfolio companies are doing. In every of our investments, we present at the board of directors, and usually you would also help the companies in terms of HR, strategy, getting financing, I mean, bringing them closer to good conditions in terms of the banks that provide good loans, etc. So this is what it differs a lot from investment banking, because we not only do transactions in terms of entering and exit, but we also have this so-called creative value path. When you do a transaction, live with the company for 5-6 years, and after the first or the second year, it becomes your little baby, which you try to basically to bring up so it would become an adult, and you can, you know, let it to the adult world. So it's quite interesting job, and differs us from other professionals. The unfortunate story that we are only very few. This is the negative. For our size of the country, we should have, I don't know, 40, 50 private equities. And our industry is in the early stage of development, which good. And for competition, I mean, currently we don't have lots of competition for deals. Mainly they coming from the Russian family offices or some big enterprises, including state, where we compete for the assets. But we have distinctive value added that we promise to the owners. Our fund usually raised for 10 years plus 2, meaning when we raise the money with the promise to give it back maximum 10 years after, which we can extend 2 additional years. So we are dealing with so-called long-term money, which is extremely scarce in Russia. And our behavior is predictable, meaning that if we would come to a company, and this is one of the selling points for the shareholders, why they should let us even for the cheaper price than, for example, some Russian family office. We wouldn't come in 1 year, 2 years. Oh, I have problems with the business. I have to sell my stake to I don't know, some very conflicted person, and forget about what I promised to you in terms of investing and raising the business, etc. So we do have quite distinctive competitive advantage versus other Russian investors. That's it.
Hi, Olek. Thank you for coming here today. And so I've got a question to you. Have you seen any shift in preferences considering ruble deterioration to USD, of course? So I mean that profits of your investees are getting lower in dollars, right? And maybe there is a shift to more companies generating revenue in currencies rather than ruble.
Yes, of course. As I said, that would be a good story. But how many companies, Russian companies, are earning in dollars? Except oil and gas, big state monopolies. No, not many Russian companies went to global markets. There are only a few. Some in the IT industry, some I saw example in outsourcing, but it's only a few examples. So they're quite rare to find the company which, I don't know, a revenue base would be like 80-70% in dollars, except the natural resources. But with natural resources, you can always lose if the price in natural resources would go down. So when we raise the fund, we present a strategy, and we're saying to investors, we're going to invest into Russia. So that's why we mainly invest into the companies operating in the local environment, and mainly revenues are generated in rubles.
Thank you, Olek. Hello? Okay. So, one question to you about your fund. At which stage is it now? Are you raising money, or are you near closing, exiting?
We were lucky. We made the first closing on the 30th of December 2013. So we raised our second fund, and we currently have, we are in the investing stage, meaning that in the next 2 years we would actively invest the money. However, I've seen the situation when the fund would put the date of the first closing to end of March after Ukraine, and basically the fundraising was cancelled, even though they would collect lots of money, but you need to do the first closing. The first closing is where your investors, LP investors, are committed to invest in the deals that you bring to them. So yes, we invest.
So you have already closed one fund recently?
There is stages. Usually you would have like first closing and the final closing. First closing, it's when you would collect like 50 or 60% of the funds. For example, our target fund size is 200 million. At the first closing, we raised 100 million. And currently, by 30th of January, we will have a final closing. This is where we say to investors, that's it, we don't do any more fundraising. And doing fundraising currently is, of course, fun thing, but, with a low probability.
I see. And one more thing, one of the most interesting part in PA is what you do with the firm when you buy it. So, is it common in Russia to enter a firm and throw out the whole management system and restructure it in a whole new way, or how is it usually done in Russia?
To do buyouts and to do turnarounds. When you would come, you know, fire entire top management, half of the middle management, you need to have experience and resources. You would need to have within your private equity specialized team out of top professionals that can do it. It starts to appear, for example, for the funds that do buyouts at some situation, because they have to, because, for example, they would invest into 30% to a stake, and the profitability of the company is going down, and the owner is ready basically to walk away from its responsibilities. For example, if there were some ratchet structure transaction, when there was certain promise on the performance. I would see in Russia, we're not at the stage where buyouts, the situation that you mentioned, it's buyouts, is quite common, but I see more and more examples. And this is absolutely standard for US and in Europe. For them, growth investment, growth means you would come to a company, would buy 30%, and would see how the company grows. You would have limited ability in terms of management, etc. But because the market grows, company is growing, I mean, you know, you can make good money. In the West, it's a different story. It's buyouts. It's a big deals. They come, you know, everybody fired, you know, we took over. They would buy company cheap and would try to sell it after turnover high. I mean, expensive price.
That's it.